In today's video, we are going to be going through Bridgewater's Q1 2023 portfolio, and this is a hedge fund that is founded by Ray Dalio. So this is essentially Ray Dalio's portfolio video as of Q1 this year. Now, in this video, we are going to be going through all of the major buys and sells that he is doing in this hedge fund, and there is a lot of major moves that is going on. It looks like Ray Dalio is very clearly rotating out of some stocks and then buying other stocks, at least as of the first quarter. However, before we get into the video, I have a very quick announcement. And that's that Stock Unlock's 25% off subscriptions is going to be ending at the end of May 31st or at the beginning of June 1st, however you want to view that. Basically, you have about 36 hours left to go and lock in a 25% off Stock Unlock subscription. And this 25% off discount will last forever as long as you remain a Stock Unlock subscriber. So if you go and lock in this discount and you're a member 5 years from now, you will still have the discount applied to your account. So seriously, if you have been considering a Stock Unlock membership, which is the platform that I use to do all of my fundamental analysis and research, and we are going to be using it in this video, then again, make sure you go and lock in that discount because the window is closing. You don't have a lot of time left, and you got to go and make sure that you lock it in before the discount window closes. Now, with that out of the way, let's take a look at what Ray Dalio has been buying in the first quarter. And we can see that the number one stock that he has been buying was Microsoft with an increase of shares of 1,400%. So they are massively increasing their Microsoft position. So let's head over to Stock Unlock's freeform tool, and we're going to take a look at Microsoft really quickly. This right here is the revenue, and we can see that Microsoft's revenue is sitting at an all-time high right now. It did go through a little bit of some stagnation, but it looks like in the first quarter, they did report some more revenue growth year over year. And now in the trailing 12 months, the company's revenue is in fact at an all-time high. However, if we take a look at the free cash flow, we can see that it is in a downtrend. It topped out here at 65 billion in the second quarter of 2022. Now it's sitting at about 57.4 billion as of the first quarter. So Microsoft's free cash flow, again, is in a little bit of a dip right now, which means that if we take a look at the company's price to free cash flow, it is sitting at 43 right now. And if we zoom out over the past 20 years, this is actually the most expensive that Microsoft stock has been over the past 2 decades. Even right here in 2021, Microsoft stock did not hit a 43 price to free cash flow. It got close, but as of right now, again, the company's price to free cash flow is sitting at a 20-year high. And honestly, I think that the stock is getting quite expensive. However, Ray Dalio was buying Microsoft in the first quarter of 2023. And we can see here that in January, Microsoft's price to free cash flow was down at 28. And then it really started seeing its significant run all the way up to 43. So Ray could have been buying Microsoft stock down here in this dip when the price ratios were much smaller or lower. And now I have no idea what he is doing with his position. It's actually going to be very interesting to see the Bridgewater portfolio's Q2 portfolio update to see if they still have their Microsoft stock, if they're trimming it down, or who knows, maybe even if they're adding more in the second quarter. But personally, I think that Microsoft stock is getting overvalued and very expensive. And I'll show you exactly why using Stock Unlock's discounted cash flow calculator right here. So what we're going to do is run a reverse DCF. And a reverse DCF basically tells us or shows us what the stock price is currently pricing in today. So, or in other words, how does the business have to perform in the future to justify today's stock price? So we're going to project out the free cash flow over the next 10 years. And I already found the metrics to show the fair value of Microsoft today. And what the company has to achieve is a free cash flow growth rate of 14.7% annually over the next decade. They have to buy back 1.25% of their shares and trade for a 25 price to free cash flow 10 years out into the future. And if Microsoft can hit all of these metrics right here, then it will be selling for fair value today. What we can also do here is scroll down, and this shows us what Microsoft would have to produce in terms of its actual free cash flow. And by the year 2033, Microsoft would have to produce $226.25 billion in free cash flow just to justify the stock price today. Now, again, in the trailing 12 months, the company has produced $57 billion in free cash flow. So the company would have to basically 4x its free cash flow over the next 10 years just to justify the stock price today. That is how expensive the stock has gotten in the market. So I am not optimistic that Microsoft is going to provide massive returns over the next 5 to 10 years from the stock price today, which again is why I am so interested to see if Ray is going to be cutting his position in Microsoft in the second quarter. Now, moving on to the second stock that Bridgewater was buying in the second quarter is Google or Alphabet. So let's head back over to the freeform tool and let's take a look at Google really quick. And we're going to do the exact same thing. Let's take a look at the revenue. And we can see that Google's revenue in the trailing 12 months is sitting at an all-time high. but it is kind of stagnating right now. It's not growing in the most recent quarter as much as Microsoft's was. However, if we take a look at Google's free cash flow, we can see that it is in a dip, but it is starting to uptrend once again. And in the trailing 12 months now, the company has produced about $62 billion in free cash flow. And the trend very much so is back on the uptrend. Now, if we take a look at Google's price to free cash flow, we can see that it is much more reasonable at about 25.6 right now. However, in the first quarter of the year, it got all the way down to a price to free cash flow of about 19.6. So in my opinion, Google at one point was the largest position in my portfolio. Another position has overtaken it now. But here on my channel, I made a video when Google was trading for a price to free cash flow of 17 at the end of 2022, saying that I thought that this stock was a massive opportunity. The stock is no longer that cheap, but it did remain cheap even in the first quarter. Now, what's interesting is if we zoom out here all the way to 2008, we can see that the lowest Google's price to free cash flow got was all the way back in 2012 at about 14.8. Now, if we go to the Great Recession in 2008, we can see that the price of free cash flow dropped down to about 16. Again, right here in 2022, Google's price to free cash flow got to about 17, which was the lowest price to free cash flow that this stock was selling for since 2012. And during the Great Recession, it was selling for around these prices as well. So it looked like Ray Dalio saw the value here as well and started buying in the first quarter of 2023 and loading up on some more Google. I don't know what he's doing now that the price ratios have expanded by about 25%, and the stock looks like it is trading for a little bit around fair value now. I don't know what they're going to be doing with their position, but to me, it's very clear why Bridgewater and Ray Dalio were buying more Alphabet in the first quarter. Now, the third stock that they were buying is Meta. This is another tech company, and let's just go back to the freeform tool once again, and let's do the same thing. Let's take a look at what is going on with Meta right now. Now, Meta's revenue has been kind of stagnating since about the end of 2021. It's kind of been flatlining. It did get a little bit of a boost in the most recent quarter, but they're not really projecting to grow the revenue that much going forward. Now, if we take a look at the company's free cash flow, it has fallen off a freaking cliff. It has literally been cut in half, and they are investing a ridiculous amount of money into the metaverse and into their AI data centers and their artificial intelligence software and everything. And it's just a massive CapEx cycle that the company is in right now. That is weighing down free cash flow, and it's suppressing free cash flow massively. Now, I am not 100% sure when the free cash flow margin is going to come back, but all I know is right now the company's cash flows are in the toilet. So now let's take a look at Meta's price to free cash flow. And this is super interesting. So right here at the end of 2022, Meta was trading for a price to free cash flow of 9.7. Basically, the entire market was saying that Meta is a failed business. This company is going under. Everyone thought that TikTok was going to take over and that Meta was just on its way out essentially. And again, I was making videos here on my channel about Meta at this time saying that I was buying it and that, I was increasing my position in the company because it was trading for such a ridiculously cheap price. Now, this discount right here did kind of last into the first quarter. It did start recovering, but it was still trading for a price of free cash flow of around 18 at the beginning of the year. And who knows, this could have been where Ray Dalio was buying the stock, was right at the beginning of the year. However, Meta stock is now up roughly 200% from its lows that it set in all the way down here in November of 2022. And now the stock is trading for a price to free cash flow of 38. In my opinion, this stock is no longer really that cheap. Honestly, I think that it's probably selling above fair value now. I don't know how much above fair value it is, but I would not be buying the stock here after it has ran 200%. The price ratios have changed dramatically. And again, it's selling for a 38 price to free cash flow now, which isn't necessarily that cheap. This is going to be another one to be interesting to see if Ray is holding his position in the second quarter, if they're trimming it down, or if they even bought more. But now let's take a look at the fourth stock that Ray bought in the first quarter. And this is super interesting because this is PayPal. Let's go and take a look at PayPal here on our freeform tool. Let's take a look at the fundamentals before we take a look at the stock price, okay? Here we can see that PayPal's revenue is actually at an all-time high in the most recent quarter, and it has been growing quite well. I mean, if we zoom out all the way to 2016, this has been a very consistent revenue growth line. And again, it is sitting at all-time highs. However, if we take a look at PayPal's free cash flow, it has been kind of stagnant, and the company did say that they are expecting $5 billion in free cash flow for the entire year of 2023, which is basically what they have been producing over the past 3 years now. Right here at the end of 2020, you can see that they did produce about $5 billion in free cash flow. So again, they haven't really grown their free cash flow in the past 3 years. Cash flow is not growing with revenue anymore. However, if we take a look at the company's price to free cash flow, it was trading for about a 72 price to free cash flow in 2021. In my opinion, the stock got massively overvalued, and now it has been downright crashing And now the stock is trading for a price to free cash flow of about 13.3. If we zoom out here all the way to 2015, we can see that this is the lowest that PayPal stock has ever traded for in terms of its cash flows and the price of those cash flows. So the market is very, very bearish on PayPal right now, despite the company's revenue continuing to grow, and despite the company still producing that $5 billion in annual free cash flow. In my opinion, I do think that they do need to find a way to grow the free cash flow in the future, but overall the revenue is still growing and the business does still look like it is expanding. So to me, it's pretty clear why Ray is buying this stock. It looks like he just wants to buy it because it's quite cheap right now, literally the cheapest the stock has ever been. And if we head over to PayPal's stock price here, we can actually see that the stock is down about 80% now, 81% if we want to round up, from its all-time highs. It's in a massive, massive correction. That's basically a downright crash if you want to take a look at that stock chart there. So those were the 4 top stocks that Ray Dalio bought in the first quarter. And what you'll notice is that these are all tech companies. And it's very clear that he was rotating more money into the tech sector. Now, what's interesting is if we take a look at the top stocks that Ray was selling in the first quarter, it's companies like Pfizer, Target, Walmart, Kraft, Kroger, Hershey, General Mills. If we scroll down, I believe there's Costco, Pepsi, Coca-Cola, Starbucks, McDonald's, and a lot of consumer staple brands in the United States. So what it looks like to me is that Ray Dalio is very clearly selling off his consumer staples and adding to his technology stocks. Now, if we head back over to the freeform tool here on Stock Unlock and we go and take a look at Coca-Cola, and let's add in a McDonald's as well. And we're going to take a look at these companies' price to free cash flows in the first quarter of 2023. So right around here in the first quarter, Coca-Cola was selling for a price to free cash flow of 27 and McDonald's was selling for 36. Now, what's interesting is, remember, Google at this time was trading for about 20, Meta was trading for about 18, PayPal was trading for about 13, and Microsoft was the most expensive, trading for about 27. This ultimately means that these tech stocks were trading for price ratios cheaper than these consumer staple companies that are growing much, much slower. I believe that they're growing their revenues at something like 3 to 6% per year. Now, when you compare that to the asset light and very financially sound businesses of Google, Meta, Microsoft, and PayPal, it's obvious that these stocks were looking like they were offering a better return than the consumer staples at the time. So again, it looks to me like Ray was continuing to rotate out of consumer staples and into the technology sector. Now, what's also interesting is Ray's largest position right now is IEMG, makes up about 5.3% of the portfolio, and they increased their position by 22.7% in the first quarter. So it's the largest position, and they're continuing to add to it quite a bit. So if we head over to Stock Unlock, this is an ETF. It's an emerging market ETF, and we can see that it is currently in quite the dip from its all-time highs here in 2021. It's down about 30%, and if we scroll down, we can see that the largest stock in this portfolio is Taiwan, then Tencent, Samsung, Alibaba, Reliance Industries, Mutan, China Construction, ICICI Bank, and HDFC Bank in India. And if we continue to scroll down, we can kind of see the diversification of this ETF around the world. We can see that the largest position is in China with 20% of the ETF, and then India with 15% of the ETF. Then it is scattered out around the rest of the world's emerging markets. Then I was going through JP Morgan's Guide to the Market, which is a monthly update that they release to the public on the overall financial markets. And take a look at this. This chart right here shows us the average price to earnings ratios of the US, Japan, Europe, emerging markets, and China. And we can see that the price to earnings ratio of the US right now is sitting at 18.2. The emerging markets is sitting at 12.1, and China is sitting at 10.5. Now, remember, the emerging market ETF that Ray owns is mostly exposed to China and then India and then all of these other emerging markets. But what you can clearly see is that China and the emerging markets right now are massively cheaper than the United States. In fact, the United States is the most expensive market out of all of these major markets right here by far. Basically, if you're looking for value, which Ray Dalio likes to do, then it looks like value is really in China and the emerging markets right now. And that could be why the largest position in Bridgewater's portfolio is an emerging market ETF with heavy exposure to China and those other emerging markets. So that is what Ray Dalio is doing in his portfolio as of Q1 2023. Again, it looks like he is rotating out of consumer staples and into the tech sector, and it looks like he is adding more to the largest position in the portfolio, which is an emerging market ETF. So let me know what you guys think about these moves down in the comment section below. Do you agree with these moves? Do you think that they're bad moves? And let me know what you think that he's going to be doing in the second quarter now that tech has been rallying massively off the lows and that Microsoft is now trading for its most expensive price in the past 20 years. It's a very expensive stock in my opinion now. Also, before we wrap up the video, I just want to remind you all that the discount, the 25% off discount to Stock Unlock, which is the platform that we used here throughout the entire video, that discount is ending tomorrow evening. So you have about 36 hours left to go lock in that discount. Don't forget, if you have been wanting to subscribe to Stock Unlock and become a paying member, then now is the time to go and lock in that discount, and it will last for the remainder of your subscription, as I said at the beginning of the video. But that's going to wrap up the video, everyone. So thank you so much for watching. I truly do appreciate it. And if you enjoyed the video, then please remember to leave a like on it and subscribe to the channel if you are new here. But again, thank you so much for watching, and I really hope to see you all again in my next video.